You open this video because you wanna know how to make $500 a day with trading, and I'll guide you step by step to achieve this goal. Make sure to watch until the end because you can lose everything you made if you don't follow the last step. It doesn't matter what your current deposit is, both you and I have one deposit, 100%. Thinking of accumulation $1,000 first and then starting trading is not the right approach. Your initial goal should be to close each month in profit, even with $100 deposit. My current goal is 50% net profit per month. Now let's take $1,000 and see what happens to your deposit in 1 year. The first month 15% is $150, and by the 15th month it's $1,061. You will start earning your initial deposit monthly and it will grow to $76. Achieving a 50% profit in the first month is possible with the right mentor or a quality community with educational materials. However, it's individual. Now about losing trades. Someone might say there are only profitable trades, but that's not entirely true. With a well-developed strategy and risk management, losing trades shouldn't and won't harm your deposit or emotional state. If you risk 1 or 2%, it won't cause significant damage. To lose your deposit with a 1% risk, you need over 1,500 consecutive losing trades. Let's consider a strategy with a 25% win rate but risk-reward ratio of 1 to 4. Even if only 1 of 4 trades is profitable, your deposit will grow. This fundamental information is crucial, especially for beginners, as I haven't seen such valuable insights elsewhere. Now let's delve into the concept of trading and growing your deposit so that even beginner can understand. Let's go! What is the concept of smart money and how does it work? The concept of smart money involves distinguishing between smart and foolish money. Smart money make up around 5% and is often managed by banks, influencing and directing market. The remaining 95% form foolish or unconscious money, lacking significant impact due to the predominant influence of the 5% smart capital. Retail traders like us fell into the second category. Types of structure. So here we have a bullish structure, which is an ascending structure. This occurs when we update new heights but do not update new lows. Like this, for example, high high, high low, high high, high low, high high, high low. Bearish structure, on the other hand, is a descending structure. This happens when we update new lows but do not update new highs. For example, it's like this: lower low, lower high, lower low, lower high, lower low, lower high. And the third one is consolidation. This is a sideways movement of prices where there is no clear understanding of market direction. What is BOSS? It stands for break of structure, and here are two examples. Here we have a ascending structure consistently updating highs but not lows. However, in this case we decided to update the low, thereby breaking the ascending structure, and overall the price direction changed. In the second example it's the same but in the opposite direction, updating lows but not highs, and at this point we update the high, breaking the structure, leading to a change in overall direction. Here's some example on the chart. So here we have a high low, high high, high low, high high. We consistently update heights but do not update lows. However, in this case we update this low, causing a structure break. After that we moved in a different direction. An important point is the confirmation with candle bodies. For instance, here the structure break is confirmed with candle body closures. Everything is visible and clear. If there were only 1 week like here, reaching this point it wouldn't be sufficient. Now, what is sweep, SVP, and why do many confuse it with BOSS, break of structure? Because a sweep is also liquidity removal but without candle body confirmation. In other words, we removed liquidity, the wick remains, and this is called a sweep. By the way, I recommend you subscribe to my Telegram channel because there you'll find a lot of useful content, market analysis, my trading setups, educational content, and valuable insight. All the links are in the video description. Check them out. The premium and discount market works just like in real life. Everyone aims premiums to buy cheaper and sell at a higher price. Premium zones are used to identify advantageous entry points in a downtrend, while discount zones are favorable entry points in an uptrend. To determine these zones, we utilize the Fibonacci tool. In a downtrend, we update the grid with values 0, 0.5 and 1. Purchasing in the premium zone during a downtrend is beneficial, buying cheaper and selling at a higher price. In an uptrend, it's advantageous to buy in the discount zone and sell at a higher price. OT zone, optimal trade and try. In the OT zone, adding values of 0.62, 0.79 and the midpoint, specifically 0.705, serves as a good entry point. In a downtrend, hitting 0.705 is an excellent entry point. Similarly, in an uptrend, reaching 0.705 is also a great entry point where limit orders can be placed. Imbalance. Imbalance is a three-candle formation where one side had an inefficiently offered price and the market tends to fill that space. It acts as a price magnet. Market on the chart from the week of the first candle to the week of the third candle. The entire candle body represents our imbalance. Imbalance can serve as a point of interest, and it's interesting to consider opening a position in this zone, anticipating reactions from buyers or sellers. Also, you can call it FVG. Fair value gap. Liquidity. Liquidity is our money, a fundamental concept in the smart money concept. When you open any order, that's your money that you add to the market, and that effectively forms liquidity. There are two types of liquidity, high and low, which refers to order located above or below the high or low, and AQ high and AQ low, almost equal highs and lows. The latter is even more crucial liquidity. Let's make an example. We move within a range from one liquidity area to another. At the top, we break the high, triggering a reaction. We swiftly move to a new low, again prompting a price reaction. Subsequently, we move back towards the upper boundaries of liquidity. Now, let's delve into order blocks. An order block is a candle of the opposite color that sets a new market direction. It later serves as a support or resistance level. For instance, consider a bullish order block, the last candle shaping an upward movement. After testing this block, it turns into a support zone, providing a good entry point for profit. On the other hand, a bearish order block, represented by the last candle defining a new price direction. Essentially, an order block aligns with POI, the zone of interest for open positions, with additional confirmation, of course. Now let's talk about breaker. A breaker is an impulsively breached order block used similarly to the POI zone. The primary criteria for breaker block include liquidity removal and structure breakage. Boss. Breaker. Let's see it. First, we removed liquidity, clearly visible. Second, we impulsively breached our previous order block, yes, thereby breaking the break-off structure, boss. And third, we tested our breaker block, after which the price started moving further in the outgoing direction. Mitigation block. Here it's quite simple. The difference between a mitigation block and breaker block is that mitigation doesn't remove liquidity, but similarly breaks our order block. Before transition to a real chart and showing practical examples, I want to share important information. All smart money tools we discuss should be used comprehensively. For example, if you only trade based on the mitigation block, the success rate won't be impressive. This is what I cover in my mentorship program, where you'll receive all materials and detailed explanations for each working tool. We'll set clear trading goals, assignments, and most importantly, you will receive support from me, my team, and the community to achieve results. In simple terms, I'll guide you step by step towards your goal. If you're interested in mentorship and learning, join my Telegram channel through the link in the description and message "I want mentoring" to the manager. He'll get back to you and explain all the conditions. Well, now let's move to the real chart and start analyzing. The first thing that catches my eye is liquidity in the form of equal highs that were removed. After removing liquidity, we got a reaction and we formed a boss break-off structure. This is one of the signals that the trend might change. Now, if we move from liquidity to liquidity, we have equal highs and we need to find equal lows. What will be the main targets for the drop? Yeah, here we have identified successful equal lows where the price will likely aim. Now we have an assumption that the price will move in downtrend. Our task is to find points of interest, zones where we can expect a reaction and where we can open our positions. To do this, we move to our structural range, expand it a bit for better visibility, and use all tools I have discussed before. First, I will mark premium and discount market zones. This can be done with a Fibonacci grid, as I mentioned, leaving 0, 0.5 and 1. I do this slightly to the right to avoid interference with the chart. Alright, what else do I see on the chart? Also I see a breaker block, meaning an impossibly breached order block becomes a breaker block. Here it is. I mark it with a rectangle. Next, I see an imbalance. I mark it from the wick of the first candle to the high of the third candle. And here I see another order block. This large white candle that triggered the subsequent downtrend. That's the order block. I mark it the same way with a horizontal line. So, what do we have now? We have an order block, a structure break, a breaker block, imbalance. Now we need to look for confirmation on lower time frames. This is currently a 30-minute time frame. Now let's switch to the 5-minute time frame and analyze a few candles to see where the price might go. Now we have tested the breaker block zone, the order block, entered the premium zone, and on the lower 5-minute time frame we have a break of structure both, meaning we have broken the structure plus an order block. Well, breaking the structure alone would be enough to open a position. Now we move to the 30-minute time frame, a higher time frame, and set our targets. If, as I mentioned earlier, we are moving from liquidity to liquidity, the main part we should close is equal low. Therefore, I set the take profit zone before equal low. You can place your stop loss either behind the previous high or, if your strategy allows, above for a more conservative stop loss. In general, we observe how events unfold on the chart. As we can see, we are moving in downtrend. Okay, but what should you do if you missed this entry point? Basically, use the same tools, the same technique. Let me show you. So, I can clean up the chart a bit, haven't changed anything, just remove this premium and discount zones. Now we are starting over. First, the premium and discount market. Yes, setting it for a new trading range. Now we begin to look for POI zones, points of interest to open positions. First, I see an imbalance. Second, we have an order block. And now we need to switch to a lower time frame, the 5-minute, and look for a local structure. The boss. In this case, I see it. Here it is. And in principle, that would be enough to open a position. Plus, there is another order block here that we tested. Another reason to open a position. Now we go back to the higher time frame, the 30-minute, and choose our targets again. The take profit zone will be, as I mentioned earlier, up to the equal lows. And we place the stop loss behind the previous high. And we observe the price reaction. We have a good execution here, and just like that, we keep moving. We could close several such trades, and in the end, we closed the equal lows. Exactly, our trading range can change and we start anew. First, the premium and discount market. Second, look for POI zones, point of interest where you can open your position and wait for reaction. Imbalance, breaker block and so on. Everything we discussed earlier. Once we find POI zones, we switch to a lower time frame and look for structure breaks. This will be confirmation, and after that we can enter the trade. I hope that this video helped you and you will trade in profit. Drop a like, subscribe, hit the bell. Don't be shy, hop over to my Telegram for trading types and more. Find the link in description. This is Alex Gold. See you soon, bro.